The stock market has created more millionaires than savings, real estate, and business combined. Now, I don't have to tell you that you need to be investing in the stock market. You already know that. But maybe you feel that you don't have enough money, you don't have enough knowledge, or you just don't know where to start. Don't worry. In a couple of minutes, I'm going to teach you everything that you need to know to get started in the stock market today with whatever money that you have. First, make sure that you subscribe down below so you don't miss any future videos in this series. And let's get to it. First, we have to start at the core of the stock market, the lifeblood of investing in arguably the world, which is money. Before anything else, we have to understand what money is and how it relates to stock. Money is an asset that represents agreed value. A dollar is really just a sheet of green paper with words and pictures on it. But because everyone agrees that it has some value, you can use it to buy things. For example, say you're driving around and off in the distance, you see those glowing yellow arches and your mouth starts to water. You're craving one of those Big Macs. As long as you have the agreed value of $5 and you value the burger more than you value the cash, you can make an exchange. This is no different from the stock exchange. Someone owns a stock and they want to sell it, either for profit or because they need the money more than the stock. As long as you have the value they agree the stock is worth, you can buy it. But wait, what is a stock? Just like money, stock is a type of asset. But instead of representing agreed value, it represents ownership in a company. I know that's meaningless to you. Let me explain. Stock is actually very similar to pizza. I'm going to be really hungry after this. A pizza can be split into 2, 3, 4, really a bunch of slices. Stock is the exact same way. Companies will split their pizza up into many slices, or shares of stock, and sell the slices on the stock market. Here's the catch though. There's a limit to how many slices you can cut. Eventually you're going to run out of pizza. And for a really good pizza or company, everyone wants a piece of the pie. Think of an Apple or Tesla. As long as those companies continue to do well and make more money each year, more people will want to be owners of their stock and they'll be willing to pay higher prices for that privilege. Now, why is this important for you? If you buy into one of these companies at $50 today and they continue to do well, maybe in a year that stock is worth $150. Now you could sell it and make $100 profit, or you can keep holding on to the stock and wait for it to go even higher. Keep in mind, that's just if you buy one slice. For the most part, with stock, you can buy as many slices at a time as you want. Now that you know you're buying pizza, let's talk about which pizza to buy. Before, I talked about some pretty good companies like Apple and Tesla. These are good options, but there's two things that we have to consider when investing. First is our investment cost. If you're just getting started here, you probably don't want to gamble your life savings away all in one go. You want to start by putting in a little bit of money and easing into it. Back to the pizza references. One slice of Apple today has an agreed value of $150. Tesla's at $170. If you don't have that to throw into stocks right away, keep watching. Our second consideration is risk versus reward. And these are always connected. The less risk you take, the less reward you get. If you take on more risk, you can get a bigger reward, but you could also end up with nothing. You must always consider this when investing. There's high risk strategies that can make or break you, and low risk ones where you won't lose much, but you also don't gain much. Those are for future videos. For you and most people, a medium risk strategy will be just right. And you probably already know it. Have you ever heard not to put all your eggs in one basket? The same thing applies with investing in stock. Investing in just one basket, like Apple or Tesla, can have a high reward because they can release some new product and blow up overnight, but they can also have just one bad day and the stock drops a ton overnight. And the same goes for any company. Now, it could be a valid strategy to invest in just one company, but for our purposes, it's too risky. What we want is diversification, to spread our money across multiple companies. And for most people, buying an S&P 500 index ETF is going to be the best way to do this. Now, that's a complicated word. Let me break it up. An ETF, or exchange traded fund, is just a collection of stocks bundled together that you can buy in one package. Instead of buying Apple, you can buy an ETF with Apple, Microsoft, Amazon, and Tesla all included. The next part is the stock index, which is just a list of stocks. For example, there's an index for tech companies, energy companies, healthcare, etc. It's just a list. The last part, S&P 500, refers to the S&P 500 index, which is a list of the top 500 companies in the US. This index is very popular because the companies in this list give the best overview of the US economy and how it's doing. Of course, like anything else, the S&P 500 has its ups and its downs, but it's fairly stable. And on average, it gives you between a 6 and 8% return on your money each year. For reference, savings accounts at most traditional banks like Chase, Bank of America, and Wells Fargo is barely anything, about 0.01%. Online high yield savings accounts are better. The highest one right now is about 4.5%, but that still doesn't make the cut. And even what's probably the second best low risk investment, which are CDs, are only at 5% at their highest. So the S&P 500 index ETF is going to be your best bet. Now, where can you buy it? There's a ton of different platforms that you can use. Vanguard, Fidelity, Charles Schwab, Robinhood, SoFi, Webull. There's a bunch more. In my opinion, it doesn't really matter where you go. You're not tied to that provider in any way, and you can always move your assets whenever you want. There are some things you want to look out for though, like their platform should be user-friendly, there should be a $0 account minimum, no transaction fees, and that they offer fractional shares. That means that even though the S&P 500 ETF on Vanguard, for example, is $350 today, I can still use whatever money I have and buy just a fraction of a slice, even with just $5. Personally, I like Vanguard, but their interface can be a little intense. SoFi and Robinhood are both good as well. Links for all these platforms are in the description below. Once you choose your platform, you have to find their ETF. Each platform has a different name for their ETF, and some sell the ETF from other platforms. If you just search S&P 500 ETF on any platform, it should be easy to find. But these are the common ones that most people buy. The biggest difference is going to be in the expense ratio, which is a small fee that you pay to own the ETF, and it's automatically deducted from your investment. The lowest expense ratios are on Vanguard's VOO ETF and BlackRock's IVV ETF. Both have a 0.03 expense ratio, so I recommend you choose one of those two if your platform has it. Otherwise, the expense ratio should be fairly low, and you can compare some other options at the Forbes link that I put in the description. That's it for the video. I hope that you now have a better idea about the stock market and how you can get started investing. For future videos, I'll be talking about different strategies, investing in retirement accounts like 401ks and IRAs, philosophies about investing, and different assets like options, Forex, real estate, and crypto. So there's a lot more to discuss. Make sure you subscribe below and you hit the bell so that you don't miss out on anything. See you all in the next one.